All right. Hey, trust you are doing well and off to heading towards a great weekend. We're just wrapping up the week here, and as always, want to share with you kind of our thoughts from the week, our macro moment on the economy, also or thoughts that are going on related to the apartment market or just in business and life in general. Yeah, I love that line up there. Stay hungry, right? You gotta stay hungry. So a couple of things going on over the last week and a half. We had the GDP numbers came in, was really kind of a blockbuster for most people compared to what they were expecting. 4.9% annualized. So that was where we were the previous quarter, about 2.1%. Definitely way ahead of most everybody on the economist side expectation. It's a reflection of the continued strength of the spending, the economy, the consumer, coupled together with also inflation numbers that came in decent at 3.7%. So again, that's off from a high of like 9% last year, 8.7, I believe is the exact number from the correlated period. But so you see that inflation is continuing to move down, which is a good thing. Now I know you and me as a consumer, price is still way up. I mean, good Lord, I was at the I was at the grocery store and deodorant was like almost, I don't know, $7.75 for a stick of deodorant. I'm like, holy God of mercy, a 12 pack of soda is like $8 or something, crazy. So, that's true. Inflation has come down. Now, on a good note, also construction prices, materials have come down. If you remember back in 21, like God of mercy, plywood was like $60 or $65 a sheet. Insanity. I mean, we saw roof costs go up so dramatically. It still is, high, but, we're seeing some of those costs come back down. We're also seeing some easing, of course, and that's reflected in that inflation number. Unemployment still really strong at 3.8%. And, so you see that that is presenting a mixed scenario. And the last piece of the leg of the equation is just yesterday, or Wednesday rather, they at the Fed held the rates. And again, when you dig into the comments, they're satisfied with where they're at. Recently, as I shared before, the market expected rates to be higher longer, and the 10-year Treasury hit 5% and then was hovering around 4.8 and change. And so that also puts a constriction on lending because that's correlated to long-term mortgage rates and long-term borrowing, both like at Fannie Mae, Freddie Mac. The Fed, and again, just so you understand, the Fed does not move long-term rates. They move short-term overnight borrowing rates, which affects, most often short-term lines of credit as well as bank loans, bridge loans, that kind of thing. So it does have a constriction in the economy and the marketplace because it's making the cost of money more expensive. So what does all of this mean? Well, now when the Fed held rate this week, you saw also the market responding to that, but also more so responding to the comments that you really are in line in the Fed committee meeting. And so as a result, the 10-year Treasury pushed down, meaning more money went into bonds, pushing price up, which in turn then brought the yield down. And as the yield came down, now it's just under 4.6, 4.58, something like that in change. And so that's a good movement from just a couple weeks ago. That's 40 basis point, which is huge. But so what does it mean? Like, okay, we don't, like some people are going to get overly jubilant. Oh my God, yeah, rates are already coming down. It's like, yeah, no, that's not really the case. That when you've got a stronger economy and you've got, thankfully, inflation coming down, what we don't want to see is inflation, start to move up again, which can happen if the economy stays strong. But the reality is we're still in a place where it's greater and likely that interest rates are going to stay higher longer. And then also, it's really critical to understand that we're coming out of like a almost 40-year cycle of rates coming down, which helped to further propel asset prices and market prices. And we are likely to be in a differing scenario now where rates are higher than where they were. And so for people who, again, in the apartment arena, let's say, or the commercial real estate arena, where they're saying, okay, hey guys, we're going to buy it today at this, and we're going to get lower rates here, and we're going to sell it here. I think that's a little bit imprudent because, again, we're going to be likely to be in a cycle where we're experiencing higher rates, more sustained. Now, no doubt for sure in the near term, meaning the next 12 to 18 months, it's going to be a higher rate market. And then, you have to look at and consider, what are the drivers of the consequence. Now, again, we would look to see some type of economic slowdown over the next 12 months. And, I believe that to be the case. Now, again, I shared with you the week before, probably now 50% of the economists think that we could avoid a recession. That still seems unlikely. I think for us, we're preparing for that as it would be expected as an event, not just praying and hoping it doesn't occur. But I think also, too, the slowdown will help further bring more money into the bond market. That's traditionally what happens historically. But again, we have somewhat of untraditional times at this moment. And but yet with that being the case, then that would help to push yields down and help to begin to retrace interest rates. Now, again, I do believe that we have that opportunity, but yet we are being prudent as a team. We discuss that. We look at that when we're talking about our underwriting and looking at any new properties, and no doubt we'll talk about that in the next video. But even too, when we're looking ahead at some of the great opportunities that we believe are there for us and for you as part of our team in 2024, we still apply very conservative metrics to it because, again, I do believe that the factors we're dealing with are going to bear out to show that we're going to be in a higher interest rate market over the next cycle, right? And that just makes sense. It's like a reversion to the mean. We've come down. Now we're, in terms of interest rates coming down, now they've come up. And even as they come down again in the near term, it's not going to resettle back to where it was. That was artificially suppressed from the 2008, 2009 period. And really interest rates over almost a decade or more were, virtually around zero for a good bit of the time. There was a couple times like 2018, it elevated briefly. But so these are things that we got to look at, and then you have to look at, well, what does that mean? So I want to encourage you for you and your business, and as you're looking at, I talked with one of our investors, and they're invested in, 75 different projects. And so there's a lot of different things going on that you need to be aware of because not everybody is approaching the circumstances with the prudency and the conservative nature that needs to be applied at this time. So again, thank you so much. Have a blessed and victorious week, for this is the week God has ordained for you.